we do have a quorum on the employees retirement board, so we'll go ahead and convene the regular meeting of the employees retirement board. Patty, can I get a roll call, please?
Philip Hardcastle,
Here.
TJ Miller,
Here.
Marvell French, David Kane,
Here.
All right, and so we will. Patty, do you have a display for the flag yet?
I do.
Let's go ahead and do the Pledge of Allegiance, if everybody will stand.
I'm trying to get things aren't going well.
Okay,
I've got too many.
not a problem.
I pledge allegiance to the
Okay,
flag
ready? Begin. Of the United States of America and to the republic for which it stands, one nation, under God, indivisible,
and
with liberty and justice for all. Thank you. Okay, and so the first item on our agenda is to approve the minutes of August 12th regular meeting of the Employees Retirement Board. So I'll entertain a motion.
Motion to approve.
Second.
Thank you, David. Thank you, TJ. Any comments, public comments?
One
All right.
reminder for board members, I apologize. Please identify yourself when you're making a motion.
All right, and so I'll take a roll call. David,
Aye.
or TJ,
Aye.
and I approve for a unanimous vote. Next item on the agenda is to approve today's agenda.
Miller, motion to approve.
Okay,
Kane, second.
thank you. I'll take roll call. David,
Aye.
TJ,
Aye.
and I approve for a unanimous vote. There are two time scheduled, there's one time scheduled item on
Excuse
here.
me,
and that is
Philip?
yes.
This is Patty. Is Marvell in? I see a couple of phone numbers on here that I didn't identify, and I think Marvell is chiming in right now.
Oh,
I'm
okay.
right here, Patty.
Okay, she's in.
Perfect. Great, thank you. Okay, the first timed item is to conduct a swearing in of Alma Torres, appointed member of the Employees Retirement Board.
Alma, please stand and raise your right hand. Do you solemnly swear to discharge to the best of your ability the duties of a board member of the City of Fresno Employees Retirement System Board and to comply with the applicable federal, state, and local laws?
I do.
Congratulations and welcome aboard. Look forward to working with you.
Thank you.
Yay.
Welcome to the board, Alma. Glad to have
Thank
you
you.
on.
Very excited to learn and to join this board. So thank you.
You'll get over that real fast.
Read. Be excited to read.
I had training today, so yeah, that is dwindling a little bit.
Yeah, well, welcome aboard. It's good to have you on board. We'll go ahead and proceed with our consent calendar. We have two items on it. Are there any that board members would like to pull for discussion? Hearing none, I'll entertain a motion to approve.
Motion to approve the consent calendar, Marvell.
Thank you, Marvell.
David Kane.
Thank you, David. Okay, and I'll take a roll call. Alma, you get your first vote.
Okay, so what do I do here?
You either say yes or no.
Okay, I will go with yes.
You know what? You can abstain if you'd like, since you, well, this is future stuff. So yeah, you can vote.
Alma,
Or
this is a
abstain.
motion to approve the consent calendar, or no,
Oh,
right?
Yes, yes.
yeah.
And there are two
Yeah.
items on the consent calendar, the date and time of the next meeting and the benefit activity report and drop applications.
Okay. That my vote is a yes.
Okay. David,
Aye.
Marvell,
Aye.
TJ,
Aye.
and I approve as well. So it will be a unanimous vote. Next item, there are no disability hearings, no staff initiated items, no board initiated items, no general discussion items. There are no information only items. Are there any proposed agenda items for our next board meeting? Hearing none. Any unscheduled oral communication? Any public comments? And since there are no employee personnel issues, we are adjourned.
And with that, Patty, I'd like to convene the regular meeting of the Fire and Police Retirement Board. Can I get a roll call, please?
Jonathan Lusk,
Here.
John Jensen, Lynn Bennick,
Here.
Donald Gross, Brad Driscoll. Don, I see you, but I don't hear you, but I get it.
Is Don absent?
No, he's here.
Okay. And Brad sent me a message. He's running late. So John's absent?
Yes.
Okay. So we do have a quorum. And with that, can I get a motion to approve the minutes?
I'll motion to approve the minutes. This is Lynn.
And a second?
Don Gross will second.
So I have a first and a second. All in favor, I'll take a roll call vote with Lynn,
Aye.
Don, and if Brad's on, not yet, but with mine, the motion passes unanimously. And we'll move down to approval of the agenda. Can I get a motion to approve?
Don Gross will make a motion.
Lynn will second.
I have a first and a second. All in favor, take a roll call vote with Lynn
Aye.
and Don.
Aye.
And myself, so the agenda passes unanimously. There are no time scheduled hearings and matters. We have two items on the consent calendar, and if there's nothing to be pulled or discussed, can I get a motion to approve the consent calendar, please?
Don Gross will make that motion.
Lynn will,
I have a first
Lynn will second.
and a second. All in favor, take a roll call vote with Lynn,
Aye.
Don,
Aye.
and with myself. That motion passes unanimously. We have no disability hearings. There are no staff initiated items. There are no board initiated items, nothing for general discussion or information only. Do we have any proposed agenda items for the next meeting? Hearing none, are there any unscheduled oral communications? Any public comments? Hearing none, with no employee personnel issues on the agenda, we're adjourned, and we will move to convening the regular joint meeting of the retirement boards. Patty, can I get a roll call, please?
Jonathan Lusk.
Here.
John Jensen, Lynn Bennick, Donald Gross,
Here.
Brad Driscoll, Philip Hardcastle, TJ Miller,
Here.
Here.
Marvell French,
Here.
David Kane.
Okay.
I think
Fire
David's
and police side, can I get a motion to approve the minutes?
Don Gross will make that motion.
Lynn will second.
I have a first and a second. Roll call vote with Lynn,
Aye.
Don,
Aye.
Brad? Not yet, so,
John is firm.
or John's here?
Yes.
Okay. John Jensen as an affirmative, and with my vote, the motion passes unanimously.
Employees, I'll entertain the same motion on the employees board.
Miller,
Motion to approve the minutes, Marvell.
Thank you,
Second.
Marvell. TJ, second. Okay, I'll take a roll call. Alma,
Aye.
David,
Aye.
Marvell,
Aye.
TJ,
Aye.
and I'm affirmative, so it passes unanimous.
Okay, moving down the agenda, or
Please
moving down.
Item B3 needs pulled from the.
Yeah, I got it.
agenda.
I
Okay,
got it.
thank you.
Moving to the agenda, there's an amendment to the agenda, B3, the closed session. We're going to pull that and reschedule it for the next meeting. So with the amendment, can I get a motion to approve the agenda? Fire and police.
Jensen will make the motion.
Gross will second.
So I have a first and a second. I'll take a roll call vote for John,
Aye.
Lynn,
Aye.
Don,
Aye.
Brad. Not on yet. So, and with mine, the motion passes unanimously.
Employees, I'll entertain the same motion.
David
Motion to
Kane.
approve the agenda,
Okay, Marvell.
Marvell.
David, you want to second that?
I second that.
Okay. And so I'll take a roll call. Alma,
Aye.
David,
Aye.
Marvell,
Aye.
TJ,
Aye.
and I'm affirmative as well, so it passes unanimous.
And we'll move down to the time scheduled hearings of Bailey Gifford on investing perspectives using ESG criteria. Who has the floor?
Good afternoon, everyone. Great to see you all. We hope you and your families are keeping safe and well. Matt Day and I really appreciate the opportunity to participate in your board today. And we do say, though, however, we are missing our trips to sunny Fresno. I'd also like to take this opportunity to thank you as well for your ongoing support. We're coming up to our 12-year anniversary of managing your international equity assets, and delighted that we've made it this far and look forward to the next 12 years as well. So Matt is actually dialing in from Edinburgh today, and I'm dialing in from Florida. And we have a presentation which should last around 20 minutes. Matt and I will discuss Bailey Gifford's stewardship approach and how we consider governance and sustainability matters as part of our investment process. Now, the name Environment, Social and Governance, ESG, takes many forms, and we consider governance and sustainability as something which encompasses all these areas. So throughout this presentation today, we'll talk a lot about governance and sustainability. So perhaps moving to page 2 of the presentation, maybe just to give you an overview. As a private partnership, we know from our own experience how critical ownership structures and corporate cultures can be to the success and the longevity of a business. Too often in investment management, active ownership or stewardship can often take second place to stock selection, and governance and sustainability matters are often seen as an afterthought. But as a truly long-term investor, these issues are essential to how Bailey Gifford invests and how we actually manage our own business. Our equity investment process is founded on the long-term ownership of growing businesses. We want to help these companies fulfill their long-term potential by encouraging them to invest in growth opportunities and to try and ignore the short-term pressures of the stock market. We take the responsibilities of ownership very seriously and see ourselves as active stewards of our clients' capital. Moving on to page 3. As a firm, we invest in companies at different stages in their evolution across vastly different industries and geographies. However, we have 5 core principles which shape how we consider and integrate governance and sustainability matters seamlessly into our investment process. So firstly, prioritization of long-term value creation. So we encourage company managements and their boards to be ambitious and focus their investments on long-term value creation. We understand that it is easy for businesses to be influenced by short-sighted demands for profit maximization, but this can often lead to suboptimal long-term outcomes. Secondly, a constructive and purposeful board. We believe that boards play a key role in supporting corporate success and representing the interests of minority shareholders. There is no fixed formula, but it is our expectations that boards have the resources, the cognitive diversity, and the information they need to fill these responsibilities. We believe that a board works best when there is strong independent representation able to assist, to advise, and to constructively test the thinking of management. Our third principle is long-term focused remuneration with stretching targets. So we're looking for remuneration policies that are simple, transparent, and reward superior strategic and operational endeavour. We believe incentive schemes can be important in driving behaviour, and we encourage policies which create alignment with genuine long-term shareholders. Next is the fair treatment of stakeholders. We believe it is in the long-term interest of companies to maintain strong relationships with all stakeholders, be it employees, customers, suppliers, governments, and regulators, in a fair and transparent manner. We do not believe that one-size-fits-all governance, and we recognise that different shareholder structures are appropriate for different businesses. And then lastly, sustainable business practices. We look for companies to act as responsible corporate citizens. We believe that corporate success will only be sustained if a business's long-run impact on society and the environment is taken into account. Management and boards should therefore understand and regularly review this aspect of their activities, disclosing such information publicly alongside their plans for ongoing improvement. So these 5 simple principles really shape our interactions with companies which we invest in on your behalf. Perhaps now moving on to page 4 and talking about our team. So firstly, I would add that focusing on governance and stewardship is not something new to us, and as a firm that's over 100 years old, has been a focus of our investment analysis for decades. However, we do have a dedicated governance and sustainability team. This team was established back in 2001, initially for proxy voting, but since then, the team has grown considerably in size and is now 24 people. In conjunction with the investment teams, they're responsible for environmental, social and governance research and engagement, and coordinating the proxy voting process for all of our clients where we retain the voting rights. This team is also responsible for highlighting any risks, opportunities to the different investment strategies across the firm, monitoring companies where we have holdings, engaging with the companies on ESG criteria, and challenging them when it's appropriate. The team is structured so that the majority of our analysts work on research and engagement activities and each have specific strategy knowledge and expertise. Therefore, we have a dedicated analyst that completes strategy-specific research, attends all stock discussions for your international portfolio, and will also attend company meetings and calls along with the portfolio managers. Voting is also an essential part of our stewardship, and the team analyses every shareholder meeting in-house. We view voting as an important tool to support ongoing engagement activities with companies and have seen voting outcomes affecting change regarding either business practices and/or disclosure matters within your portfolio. And then lastly, I would add that the importance of governance and sustainability is instilled throughout the investment floor, and as soon as we have people joining the firm. So for example, we have an annual intake of investment graduates. We all participate in a 5-year training program. In their first year, they are introduced to proxy voting, governance and sustainability matters, And then they spend a period of time within the governance and sustainability team as part of their third year. So this really helps the integration and material relevance of governance and sustainability factors when they are analysing companies. I was going to hand over to Matt unless anybody wants to ask questions, or we can do this, do the questions and answers at the end of the presentation.
I think we're good, Julie.
Okay, Matt.
Thank you, Julie. Good afternoon, everyone. So my role is to try and bring some of this to life as it pertains to your international portfolio this afternoon. And as Julie said, governance and sustainability really matters when long-term investing. It's a key component of the strategy's investment philosophy. That is a belief in long-term investment, in genuinely active management, and investing in high-quality growth businesses. Now, with the average holding period of investments in your portfolio of some 7 years, it's vital for us to understand that the way a company is run and managed will have a significant influence on how successful an investment it will be for you over the long term. We have to think about the sustainability of the growth opportunity, the durability of the competitive advantage that the company pertains, and of course, the long-term stewardship of the business. So we've included our research framework here on page 5 of the handout, and you can see that stewardship sits very much central to this. For us, stewardship is that combination of ongoing company monitoring and active ownership through voting and engagement. We follow our stewardship principles, which Julie's discussed, and we place great emphasis on topics such as management alignment with shareholders and capital allocation. This framework forms the basis of all investment research that's written for your portfolio. And it's important to highlight that whilst we do benefit from the insights from Tara, our dedicated governance and sustainability analyst, as Julie says, our work on governance really is an investment floor-wide activity, and all of the investment team are contributing to this. The benefits there are that we can really pick up on any sources of potential engagement from an early stage in our research process. And it's very much this ongoing assessment that may impact whether we choose to buy a security, to sell, or to resize positions within your portfolio. It also determines how we choose to vote at company meetings on your behalf, and how we engage with management teams, the two principal levers we have for influencing change. Ultimately, we want to be in a position where we can step back and trust management to take a long-term view and to look after our clients' capital. So what does our engagement with companies look like? Well, as you might imagine, it really is stock specific, with engagement taking different forms depending on circumstances. What we do tend to find is that our reputation at Baillie Gifford as a long-term and patient investor is welcomed by companies. Baillie Gifford is a name that companies like to see on the shareholder register. And we think this helps with access to key decision makers at management teams and builds for more meaningful interaction. We're often asked by companies for our opinion on things, be it the latest changes to stewardship codes in Japan, or more recently with the likes of Alibaba, the Chinese e-commerce business, who reached out to us for our input into their disclosures within their annual reporting. And with a bias towards quality in the portfolio, it's not surprising, therefore, that our starting point of engagement really is to try and support management, to engage and to understand. At the start of this pandemic, we wrote to portfolio companies to encourage them to continue to take a long-term view and to assure them of our continued support through a period where profits and operations have undoubtedly been affected. And we also wanted to encourage them to continue to behave responsibly towards their employees and other stakeholders during this challenging times. Our engagement with Scout24 is another example of an important role of support that we can play. And in this case, with a young company facing short-term pressures. So Scouts are holding in your portfolio. It's Germany's leading real estate portal and an online marketplace we feel has a very strong runway for growth. So much so that private equity has been circling this business for some time. And our engagement over the past year or so has been central to the formal rejection of a private equity bid, which we felt materially undervalued the business. There was widespread public criticism of the management team and their handling of the situation, and there was also activist challenge and proposals for further change at the board. Baillie Gifford issued a public statement strongly opposing these actions, as we felt it could be damaging to the longer term value enhancing prospects of the business. And we increased our efforts to provide support to what was a relatively new management team. Ultimately, with the bid failure and the pushback on these activist demands for board changes, we feel it's been favorable for the company. Recent results would suggest that it's been positive and had a positive impact on company operations. But it's fair to say it's not always about support. Our role is to probe and to challenge management, and we're quite happy to vote against management as part of management resolutions in AGMs. An example would be our work with Ryanair, the European low-cost airline. We've engaged extensively with this company over the past few years, which we believe has resulted in some material improvements in governance and shareholder rights, though there's still plenty of work to do. We've engaged on topics such as union negotiations in terms of pay for their employees, board composition and succession planning, progress and their preparedness to reduce their carbon footprint, and their management remuneration policy. But perhaps our biggest success with this company has been Ryanair agreeing to actively provide holders of American depository receipts with their votes for the first time. So City of Fresno would be a holder of an ADR for Ryanair and was able to vote actively at the AGM for Ryanair in 2018. So this is a significant change which has been impacted by our engagement. And just because we're investing in high quality companies as well doesn't mean that all these businesses are perfect. And some of these holdings do have some environmental challenges. CRH would be an example of this. It's a leading building materials and aggregates business that we purchased as we came out of the great financial crisis. It also happens to be the highest carbon emitter in the portfolio. That said, its disclosure and its sustainability reporting is among the best in the sector. And we've discussed with management the various ways it's altered its cement manufacturing processes to try and make them less carbon intensive. The company are also exploring new technologies to ultimately reuse carbon within that process. It's an early stage in the development there, but we feel assured by the progress and ambition that's been shown by that company. CRH would also be an example of a company where we've engaged extensively with on their management remuneration policies, which we feel warrant some grounds for improvement as well, and we hope to see change there in the future. So perhaps turning across to page 6, I've talked about just some of the examples of our engagement work, but we report full details of all of our voting activity for clients in our quarterly reports, including the rationale behind our decision making and details of broader company engagement. And in addition to this, we produce an annual stewardship report, and you can see this, the front cover of this on page 6 here, which really provides a bit of a lens to what we're doing in this space, what we're doing, why we're doing it, some of the success stories, and some of the disappointments as well. And this year as well, we've also highlighted 3 areas that we're building a targeted engagement plan over the next 3 or 4 years, areas which we think could have a material impact on your portfolio. Our work on carbon is underway, having profiled the portfolio with our engagement focused on those holdings that have been identified as being the highest emitters. There's more work to come on supply chains, and data security and governance will follow in due course. This is an interesting document, and it's certainly one that we'd be delighted to share with you if it would be of interest. So I guess just to sum up before we take any questions then, we hope that this short presentation has really provided an overview and underlined the importance that we place on governance and sustainability. As Julie says, this isn't new for Baillie Gifford, it's central to what we do. And as good stewards, we strongly feel that it's not simply good enough to react to things when they go wrong. We have a responsibility to be proactive, to use our reputation as thoughtful, long-term investors, to actively engage with management teams, and to help enhance the long-term profits and sustainability of the companies that we invest in on your behalf, with the ultimate goal, of course, to improve investment returns. Be delighted to take any questions that you might have on what we've discussed.
Maybe if I could, I'll just add a little color. You'll recall that NEPC has given 2 presentations now on ESG from a broader perspective in terms of what it is. And during those conversations, I suggested that we were really supportive of people who have integrated ESG into their investment approach, as opposed to having a a separate screening approach, for instance, negative screening to eliminate fossil fuel companies or something like that, but a more proactive look at companies that holistically included ESG factors as well as all financial factors and other considerations. So in a sense, that's why we asked Bailey Gifford to present today. And that's kind of the background and the framework I'd think about what they were doing.
This is Lynn Bennick. I really appreciate your presentation. This is something of great interest to me. I don't know if I should address this to Rob, but I'd love to see a copy of this document on the summary of the stewardship activities, if that's possible.
That's absolutely no problem. We can send it to Rob and to Chad and share it more broadly. This is the second time we've produced such a document, and it's really just to sort of bring to life, I guess, a lot of this good work that, as Don alluded to there, it really is integrated into what we're doing. It's not something new. It's not a box ticking exercise. It's part of all of our investment decisions, which we're making on behalf of your plan participants. So delighted to share that with you.
Thank you.
And we'll forward that on as soon as we get it, Lynn.
Okay, thank you.
This is Phil Hardcastle. I think it's a great report, and I'd love to see it as well.
Okay, is there any more questions or comments? Okay, then how about we wrap our discussion up? Anyone want to add anything in closing?
No, well, thank you all. It was great to see you all, and keep safe and well.
Thanks,
Thank you
Julie.
very much. Appreciate
Thanks,
Julie.
Matt.
Thank you, you
Thanks,
too.
Matt.
Thank you. All the best.
With the conclusion of that presentation, we can move to our second time scheduled hearing, which is Northern Trust presentation and review of custodial services, securities, lending, and brokerage commission recapture programs provided by Gerald, Don, and Antoine.
Hey, good afternoon, everyone. How's everyone doing?
Hey, Gerald.
So first off, thank you for your time and having us present to everyone today. Not a whole lot's happened since this time last year when I was presenting to the board. It's been pretty quiet, business as usual, right? So at Northern Trust, we did institute our business resiliency program back in March of this year. Most of our employees are working from home currently. We do have a critical crew of staff that comes into the offices and the off-site centers that we have set up on a daily basis for their work, for example, like a wire room, different things like that. And we also have a couple associates that come in a couple times a week to collect and deposit checks for our clients. We have been working on our return to office plans, and it will come through in phases. Since my wife Monica works at a hospital, I've been designated to the last phase since it is considered high risk. But the most recent update that we've received is that most partners should not expect to start returning to office in waves until sometime in January 2020 at the earliest. Although with the current pandemic and the timing, plans and timing can change, and it is somewhat fluid. So as things continue to either get better or deteriorate, more decisions will be made. But good afternoon, everyone. My name is Jerry Sinish. I am a relationship manager at Northern Trust, and I have with me Don Anderson from our securities lending team and Antoine McGruder from Northern Trust Securities Incorporated, which is our brokerage arm. And I know they're both on. So we plan on starting this presentation with a brief overview of Northern Trust, our public funds team and custody services. And then what I'm going to do is I'll turn it over to Don to talk about your securities lending program. And then I'll turn it over to Antoine to give an update on the commission recapture program and brokerage in general. And from there, we'll wrap it up with going over our class action survey. Does that sound good to everyone?
Sounds great.
This presentation should take about 20 to 25 minutes, and I hope that works for everyone. So if you will like, starting on slide 3 of the presentation. There we go. At Northern Trust, we have been providing client-centric solutions for the 125 plus years. Our vision is to be our client's most trusted financial partner, consistently creating long-term value for all of our stakeholders. A number of key factors in achieving this are, for example, our focus on our core businesses, asset servicing, asset management, wealth management. That's our core focus, and that's what we focus on. That is different from many other banking peers who focus on more volatile activities such as investment banking, underwriting mortgage loans to subprime borrowers, and leveraging to lending to hedge funds. Another example is just a history of our organic growth. We expand our capabilities and reach an organic-led manner while focused on our core business lines and client satisfaction. So everything we've done over growth over time was specifically for our clients, and it was done in a measured approach. We aren't wholesale buying places and trying to incorporate that and have that interfere with our culture and our client-centric culture. On slide 4, we see an illustration of our client-centric focused business model. Our 2 client types are wealth management clients, like affluent individuals and wealth family offices, and our corporate institutional services, which is for institutions like yourselves, pension plans, corporations, not-for-profits, different entities like that. Our clients are our core, and for our clients, we focus on asset servicing and settling trades. Asset servicing, which is items like settling trades, collecting income, reporting on your assets, reclaiming taxes withheld in certain markets, etc. And then we also focus on providing clients with investment management solutions through our asset management group. So that's what the 2 circles are around our clients. And then we all utilize the same global operating platform, as you can see in this picture here, which results in a more seamless servicing of our clients. We currently have, as of 6/30/2020, 9.3 trillion in assets under custody, 1.3 trillion in assets under management, and 5.8 trillion in assets under administration. Slide 5. And anyone feel free to just cut me off and interrupt me if you have any questions. And then we can also have some questions and answers at the end as well. So whichever works best for you. So if there's something that catches your eye or something you want to discuss, just bring it up and then we can discuss it. For slide 5, the main takeaway for this slide is that our core focus is on asset servicing and asset management, as I mentioned. Functions like investment banking, which can cause conflicts of interest, is not a business that we are in. We don't do retail banking, the credit cards, consumer finance. Those are not any of our core focuses. Our core focus, once again, asset servicing and asset management for our clients. If I move down to slide 6, this highlights our public funds team within Northern Trust. Our public funds team was established in 1987, and we have 196 clients with 900 billion in assets under custody. So we have a very large public funds team here. The bottom left shows our client gains and losses, and you can see we brought in over 50 relationships since 2014. If you net it out with the 8 losses, 2014 into 2018, that's a net of 49 more public fund clients in our team than there were at the end of 2014. And due to our growth, we do now have several more relationship managers on the team to ensure that we are continuing to properly service them. We do have a total now of 27 client servicing professionals on the team. And we do continue to have a commitment to technological development, as we plan on spending an estimated 3.1 billion on technology initiatives through 2021. And then from a legal perspective, we have no litigation in our FX practices, no pay-to-play actions or investigations, and we also have no Department of Justice actions against us. If we move on to slide 7, this is a representation of our California clients. This is just an sampling. This is not an all-inclusive list. But just to mention a couple highlights, I also do work directly as a relationship manager for Fresno County Employees Retirement Association, the Golden Gate Transit Amalgamated Retirement Board, Santa Ynez Band of Chumash Indians, and the San Manuel Band of Mission Indians. In addition to, I back up a majority of these clients too when Claudio is out of the office. So I do work pretty closely with a lot of California clients. We really do enjoy our work in California, and we have some great relationships out there. If we move to slide 8, Slide 8 shows our financial strength and stability. So Northern Trust is unquestionably one of the strongest financial institutions in the world, well positioned for continued investment in our businesses across market cycles. This could be evidenced by looking at the many indicators of financial strength, including a strong capital position. Items like we have an extremely strong position against measures, including the size and risk of assets on the balance sheet and our management team's attitude towards prudent investment. So we do take safer investments, and then also our management team is very prudent, and it is a very strong differentiator in determining a safe environment for your assets. We do have a strong credit ratings. Standard & Poor's assigned us the highest credit ratings of any comparable U.S. bank to our corporate main subsidiary, the Northern Trust Company. Our ratings reflect our stability, conservative business strategy, and our prudent management of risk. And then we also have an enduring balance sheet of strength. As a result of consistently focused strategies and conservative business practices, we are able to maintain low risk balance sheet, which is characterized by our high liquidity and our loan to asset ratio. So if you're looking at it, loans and leases are 22% of our entire balance sheet. A majority of it is securities and money market assets. If you don't have any questions, I'm going to go ahead and move on to our custody services. On slide 10, I have an overview of your servicing team. Jeff Porta is our practice lead, and then Patty Somerville is my direct manager. And she came from a relationship manager role in the public funds team as well. So she is very knowledgeable of the public funds base, and it's great having her as our manager. My backup is Claudio Basoga, and then our account manager on the relationship is Andrea Rojas. We also work with Chris Naglieri and IRAS. So IRAS is Investment Risk and Analytics Solutions. So he works on your risk reporting and performance related items. Daniel J. Curie in Treasury Management, think more so along like banking, different things like that. Don Anderson, who's on this call as well for securities lending. He's your securities lending relationship manager. Tamara Doy-Beck, who's your investments relationship manager. And then we work with various teams of product specialists to help service your relationship, asset pricing teams, coding, income processing, proxy services. And then also on here is the brokerage related items like Antoine McGruder. If we scroll down to slide 11, that shows our global presence. We currently have 25 global locations in 53 countries with over 24,000 staff. Our two main operation centers in the US are located in Chicago and Tempe, but we also have operation centers throughout the globe. We do believe in that follow the sun type philosophy where it's essentially 24/7 type servicing. We do have operations in EMEA, and we do have it in APAC as well. Slide 12. This is our complete solutions continuum. And I highlighted in orange a sampling of some of the services that City of Fresno Retirement Systems uses. As you can see on this slide, we have solutions across multiple categories for our clients that they could utilize. You're currently using our performance analytics, transition management. So what transition management does is they help take on assets from a terminated manager and build the portfolio for the incoming manager. So that way the performance could start day one for the incoming manager. It leads also for a much cleaner transition between managers to help track their performance. If we move to slide 13, we do use a single global operating platform across all regions and clients to receive and capture and trades, to safekeep the assets, collect the income, facilitate corporate action decisions and proxy vote decisions, reclaim taxes, and report on the assets. The data is consistent because we do use a single operating platform. And then once again, we have operational teams throughout the globe. So I mean, it's single point of access, customized services, data, and 24/7 reporting. On our passport system, anyone on the staff at City of Fresno could go into that has passport access could go in there and pull up reports and other live information on the portfolio. If there's something going on currently in the market, you could pull up and see your exposure to that firm or to the underwriter and different things like that. Any questions so far? If not, I'm going to go ahead and then turn it over to Don Anderson from our securities lending team to talk about your securities lending program.
Thank you, Jerry. This
Thank
is Don Anderson. This is Don Anderson from Securities Lending Group, and I'd like to ask you to move forward to page 16 of our presentation, if you can. I intend today to go through, similar to what we've done annually, a quick review of how securities lending works as a review for the board, talk a little bit about what Northern does, and then talk about your earnings. Please feel free, if there are questions, to just ask as I'm going through the presentation. So if we start on page 16, just a reminder of who the three parties to the transaction actually are. It's yourselves as the beneficial owner of the securities, Northern Trust in the middle of the page acting as your lending agent, and then on the right side of the page, the borrowers. And the way the process works is either the borrowers can come to Northern looking to borrow certain of your securities, or we can go to the borrowers and say, here's what we have available. So that's really step one of initiating that loan. We then negotiate the terms with the borrower, which effectively means what the borrower is going to pay to borrow your security and what type of collateral they're going to put up to borrow that security, whether that's cash or securities. Then we take the collateral in from the borrower. We move the security out to the borrower. Every day that we have your securities on loan, we mark those securities to market. So if the value of your securities on loan goes up, we get more collateral from the borrower. If the value goes down, the borrower may ask for collateral back from us. During the entire time that your securities are on loan, any dividends or interest that you're due, you continue to collect. The only thing you don't have when your securities on loan is the right to vote a proxy. That's the only difference while securities on loan. At the end of the term of the loan, the borrower gives the security back, we give the collateral back. If you look at the bottom of the page where you see non-cash collateral or cash collateral, when we take non-cash collateral on your behalf, we simply hold that for you. When we take cash collateral, we reinvest that for you in order to earn additional income. If we look at the next page, page 17, we break that income into two components. So number one is what we call the intrinsic value spread. And the best way to think about the intrinsic value or lending spread is what's the fee the borrower is willing to pay to borrow my security. And then the reinvestment spread, anytime we do a cash loan, we really base that cash loan on the overnight bank funding rate or the Fed funds rate. And whatever we can generate on the cash above that level is considered the reinvestment spread. And that's how we really look at the two components of securities lending income. If we move forward to the next page, page 18, I have an example of a non-cash loan and a cash loan and how the revenue is actually generated. And the non-cash loan is actually very simple. It really gets to just that fee that I'm talking about. So in our example, we assume that we lend $25 million worth of a U.S. equity for 30 days. So the first thing we do is take in $25.5 million of collateral, and in this case, it's just a U.S. Treasury. And then we simply charge the borrower a fee of 20 basis points for those 30 days. That would generate $4,167, and then at the end of the month, Northern takes a fee of 30% of that, as that's how we really get paid. What's left are the client earnings. So that's simply the concept of how a non-cash loan works. If we do a cash loan, it's a little bit different. Again, we lend a security worth $25 million, and we take in $25.5 million of cash in this instance. So the difference is now that we have the cash, we reinvest that cash. And what we're assuming in the example is that the Fed funds rate is at 1/4 basis point, but we can invest that cash at 35 basis points. So investing the cash for 30 days at 35 basis points would generate 74.3750. But the borrower in this instance says, I gave you $25.5 million cash. I could have invested that elsewhere. So pay me something back. And that's what we call the rebate. And in this example, we agree to pay 5 basis points back, which would be $1,062.50. So what happens here is basically what we earn on the cash minus the rebate that we pay back to the borrower generates the gross revenue. So in this instance, we've generated a spread of 30 basis points or $63.75. Again, Northern would take their fee, and what's left are the client earnings. So that's really how revenue is generated through the securities lending process. If we go to page 19, just a quick picture of where Northern's program is. We have about $1.3 trillion in securities available for loan, about $161 billion on loan. So about 12.3% of what we have available we actually have on loan. We have 467 clients across 31 countries. We work with 74 different borrowers. We're in 35 different markets, and most of our borrowers are again at a very high credit quality. Moving to page 20, we always talk about risk in securities lending because I'm talking about generating revenue for you, and anytime you generate revenue, there has to be some type of risk. So there are 4 main risks in securities lending. Number 1 being borrower risk, and what that means is what happens if a borrower defaults and the collateral is not sufficient to cover the value of your securities. Well, what we do, number 1, is review all the borrowers that are in our program so that we're only lending to higher quality borrowers. Then we go into that over-collateralization that I talked about and the daily mark-to-market process so that we're always in an over-collateralized position. But what may give you the most protection ultimately is that we indemnify you against that risk. So if something happens, that becomes Northern's issue if a borrower defaults rather than the city of Fresno. Next, we have trade settlement. And what this means is, what if your manager sells a security while it's on loan? Number 1, what we do is we try to reallocate that loan. So in other words, if you're lending IBM and your manager sells it, chances are somebody else in our program also owns IBM. We move that client into the loan, move you out, and your trade settles. If for some reason there's a problem with that, that's where our traders get on the phone with the borrowers and can increase the cost to borrow, can make it more difficult for that borrower to keep the security on loan. If for some reason the trade does not settle when it should settle, we offer trade settlement protection, which means you start earning the stiff income that you should have on the proceeds on the day the trade should have settled. If there's ever an overdraft charged because your manager says, I sold ABC, I bought XYZ because I thought I had the cash, Jerry's group will waive that overdraft charge. So you're fully economically protected there in terms of trade settlement. The next 2 risks are specific to cash collateral, and the first is cash collateral reinvestment risk. And this is the risk that if we buy something with that cash collateral that for some reason goes down in value and we can't sell it at everything we're buying, or we're buying short duration assets, if we can't sell it again at $1, that is a risk that would reside with the client, just like any other investment. But what we've done and what's really happened in the industry since 2008, everybody has higher quality, shorter duration portfolios to mitigate that risk.
Don?
And, yes.
Sorry, what is your weighted average days to maturity running right now?
Let me scroll forward a little bit. It's going to be around 30, I know. It was 31 days at the end of June. And I know it's still in that same ballpark.
Thanks very much.
Sure. Last thing I want to touch on then is interest rate risk. And this is a risk that if for some reason we were to get, where I talked about that rebate that we're paying to the borrowers, that's always set off the Fed funds rate. If the Fed surprised everyone and raised rates, we might not be able to cover that difference if the rebate spiked in a hurry. Obviously, in the current environment, we don't expect to see any kind of rate increase for years. And I was actually on the line with a portfolio manager a couple hours ago, and he said Northern's official stance is we don't expect to see rate hikes for probably at least 5 years. So we're in a very, very low interest rate environment for a long time at this point. So that risk pretty much does not exist in the current environment. Next, I just wanted to hit on page 21, borrower risk management very quickly. And again, this is the risk that all clients used to primarily be interested in. What if that borrower defaults? Well, what we do in terms of determining who those borrowers are is really, I think, the key to the process. Every borrower that comes into our program goes through a full credit review just as though we were making a loan to them. They go through annual updates, they go through quarterly updates, but what I look at is probably the most valuable piece of information is they're monitored every single day. So if there's a CEO change, a bad earnings release, the Department of Justice is in their office, or whatever might be happening with a particular borrower, we're looking at that. Our analysts are looking at that on a daily basis to say, what business are we doing with them? How does this change our perspective of who that borrower is? Do we change a credit line? Do we call some securities back? What do we do there? So it's really the ongoing monitoring that I find ultimately the most valuable because things change every day, especially in the market that we're in now. So that's just very quickly borrower risk management. Next on page 22, I wanted to mention cash collateral management a little bit and what our portfolio manager's philosophy really is. And they have three main tenets that they follow, and it's really in order. Number one is principal preservation, because the cash that we take in from the borrower, we ultimately need to give back to the borrower. So number one is always principal preservation. Number two is liquidity management, because securities go on and off loan every day. So there's always volatility in terms of how much cash they're managing. So they always try to keep a buffer of at least 20% in overnight securities so that there's always enough there in case the market drops, in case borrowers start returning, they're well prepared for that. And then third is yield generation, because ultimately we are looking to generate revenue for you. But it's really looked at kind of in that 1, 2, 3 order there in terms of importance from the portfolio management perspective. Next, I wanted to just make a quick comment on technology on page 23. Global Securities Lending in the middle is our proprietary system. It's our trading system. It's our operations system. It's really the lifeblood of what we do in securities lending. But it's also linked to everything that surrounds it in this picture, being the online trade platforms that our traders are using, data providers where we're getting and receiving prices and information on what's going on in the lending market so we can price the loans accordingly. Then on the right side of the page, cash collateral management, we utilize the BlackRock Aladdin system from a portfolio management standpoint. So every time we're taking cash in or taking cash out, our portfolio managers are immediately notified so they know if they have more to spend or if they need to be mindful of liquidity. We mentioned machine learning down here. Roughly a year ago, we started automating a bit more of our trading with a real goal of hitting some of the mid-level stocks where we thought we'd be able to generate some more revenue by having our traders have a little bit more information. So we've been working on that. We've been utilizing it a bit, but again, I think in the current market, I'll reiterate what Jerry said. Obviously, we're not going to be in the office soon. Trading has run, as smoothly as it possibly could, but little things like this may not be getting quite the attention that they would have if we were not working in the environment that we're all working in today. Lastly, everything that we do then in terms of the loans, the cash collateral, and it's all pulled together within the Global Securities Lending System, delivered out to you via our Passport reporting system, which is the same system that you get your custody reporting from. Next, I'd like to just hit on the market a little bit on page 24 and into 25. And the story here really on the cash side is obviously in March as COVID really took effect and we had massive rate decreases by the Fed. And what this really meant from the securities lending standpoint is if you think about that portfolio invested out 30 days, when we had those massive rate decreases, that gave us a higher spread basically for a short period of time there for, let's say, 30 to 60 days, because we had assets invested out further. We didn't have everything in overnights. So there was a gain there for clients on the side. But again, we expect very, very low rates, and we expect that to continue. If we go to page 25, you can see the portfolio that you're invested in, our SL Core Stiff portfolio, which is about a $13 billion portfolio. And as I pointed out, about 30 days on a weighted average maturity basis. And we have about 27% in overnights. That appropriate liquidity in place for your portfolio. Next, I wanted to just talk a little bit about the lending side and what we've seen there recently. And again, as I'm sure you've heard from many of your investment managers and your consultants, the story is what's happening to stocks that may be impacted more by COVID. So in our world, that's airlines, cruise lines, travel, everything that people are not doing now. So those have become certainly big shorts in the market, which means they've been very attractive from a lending standpoint as well. The other place that we've seen demand was probably in really the month of March and April. There was demand for treasuries, your typical flight to quality. So we saw a heavy demand there. Then we've also seen demand for ETFs that are tracking different Chinese indices. And again, because of everything that's been going on in the world and the market and the impact there. So very much, I think, what you'd expect to see. The last comment I'll make with respect to the lending side is typically in the second quarter of the year, we see a spike in demand for international equities because that's when they pay their dividends. And there's a dividend arbitrage strategy that the borrowers can execute. Due to what happened in the market, many of those companies have suspended or eliminated dividends. So we didn't really see that spike this year. Again, talking earlier to one of our equity traders today, he said that there is the potential that by fourth quarter, some of these companies may reverse that suspension of dividends. And if they do, we think we may see a little spike in the fourth quarter. But that's all, at this point, guesswork and estimation that we may see something like that. So finally, to get to what you're probably all most interested in, where are your earnings this year? So if we go to page 27, what you can see is over the past few years, you've had a slight decline pretty much every year. So this year earnings were down about 100,000 from just over 800 last year to 700,000 this year. If we go forward to page 28, you can see where your earnings come from. U.S. equities are clearly the key asset class for you at over 50% of your earnings. And then global equities really are the second highest. And the one thing that I think I've told you before is your U.S. corporate bond portfolio actually is a pretty good portfolio. It's something I guess I don't see as many clients with the corporate bond exposure and seeing solid returns there, but for your portfolio, we consistently see that. So that very quickly are your earnings for the year, but more importantly, on page 29, we have the year-over-year comparison, where you can see the difference as to why are your earnings down 100,000. And what I'll really look at there are two things. Number one, in your corporate bond portfolio, we had a drop there. There were fewer securities available and a lower percentage on loan. So we kind of got hit a little bit on both sides there. Less available and then also lower demand. And then the second big piece really is the global equity piece. Again, a small amount, not meaningful, less available, but a lower percentage on loan, meaning less demand from the borrowers. And those are the two big components that dropped your earnings this year, year over year. And then lastly, on page 30, I always like to highlight where your top 10 earnings are coming from. And I'll just comment on a couple of those. For the most part, what you're seeing here are hot stocks, meaning someone is shorting these securities and they're in high demand. So that's the case in terms of Antero Midstream. I believe they had some earnings challenges a couple of quarters ago, and that wound up driving some short interest there. Trupanion is a security that I believe it was your top performer last year. They offer pet insurance, and again, I think people are looking at that and saying, is that a sustainable business model? There are other insurance companies who have moved into that space, so they've been challenged. And then finally, Naspers. This was a really short term opportunity. Naspers is a German company that went through a spinoff, and we were able to get a very high spread for a very short period of time as they went through that spinoff based on the election that your investment manager made to take shares or cash. And it was in the fourth quarter last year, so unfortunately I don't remember which election they made, but I do remember just kind of the highlights of what Naspers was and why it was a short-term opportunity there. And with that really concludes my comments on lending. I'll be happy to take any questions or pass it on back to Jerry and to Antoine.
I have a quick question from NEPC. It's a short period of time, but this year, have you seen any trends from institutional investors about their securities lending program? Are they expanding it, cutting it back, getting more conservative on their collateral? Anything you've seen or nothing?
I'd say what we have seen was really probably in the month of March and April, where we were just highlighted again because everybody remembers 2008, and a lot of questions, a lot of, what are you doing? Tell me why I should be comfortable with what you're doing. We had, of our 470 odd clients, we had maybe 10 who temporarily suspended their program, and I believe all but 2 have actually already come back into the program. So a lot of questions, a very small number of suspensions, and most are back.
And I'll direct this to the board. This is a complicated, kind of esoteric area. So I'd encourage questions, especially for the newer board members. It's a little complex, but kind of interesting. I'm looking at you, Jonathan.
And I'm looking at Alma.
Actually, if I can help a little bit, Don, do you mind giving just a basic explanation of what securities lending is for our newer board members?
Okay, sure. Let's think about it this way. We as your custodian have your pool of assets, and for one reason or another, and I'll give you a couple of reasons, somebody like a Goldman Sachs or Morgan Stanley, someone like that, has a need for your securities, whether that's to cover a short position, help settle a trade where it's cheaper for them to borrow than to go out in the market and buy a security, or perhaps to look at that dividend arbitrage strategy that I mentioned. They have a reason to borrow. So what they do is, again, we work with them. We go to them and say, we have this available. They come to us. Here's what we're looking for. And they'll put up the collateral and borrow your security, and they'll go settle the trade that they needed to settle or cover their short position. And it really helps from a liquidity standpoint to keep the market functioning. And by having your pool of assets available, what we can do is add a little bit of incremental income at the margin as opposed to just having your securities just sitting in custody with us.
Thank you. And then you mentioned specifically the title beneficial owner as opposed to owner. Can you differentiate so that the board members can understand that difference?
Beneficial owner is the term that we use for client, meaning you are the owner of the security, but then, as I said, we act as your agent. We lend it to a borrower. You still are effectively the owner because you can tell me today, I want this security back. We go and we get it from the borrower, and it's back in your portfolio. So it's probably more of a legal term that I probably would not be the best person to define it, but it's you are the ultimate owner of that.
Correct. Yeah. Loan. The ultimate owner. Correct. Yeah.
Right.
Thank you. I think that clarifies most of it, and I yield the floor, Mr. Chairman.
Okay. Thank you. And I'll turn it back to Jerry.
Yeah, and if any other questions come up, just reach out to us, and after the meeting or as you're reviewing the materials, and we could get you the answers you're looking for. I do want to be mindful of everyone's time, so we'll try to get through the last few slides as efficiently as possible. So we're going to go talk briefly here about commission recapture program. Before I do that, what I'll do is I'll go ahead and then turn it over to Antoine. So we are restructuring our commission recapture program. So I'm going to go ahead and turn it over to him to talk about what we're doing there and why we're doing that, and then to see if you guys have any questions about that in general, because I know one of the topics are going to be later in the board meeting to talk about the commission management program. So Antoine, if you would like, I'll go ahead and turn it over to you, and you could talk about what we're doing there.
Yeah, sure. No problem at all. So hi, I'm Antoine McGruder with Northern Trust Securities, the brokerage arm of Northern Trust. And unlike the rest of the bank, we actually stayed open during the pandemic. We never closed the trading floor. We did separate. We have 2 floors in different areas, but we never closed. So for the new board members, commission recapture is actually a service that we provide. So you want to look at commission recapture as more as managing your costs or your expenses that your managers are paying on your behalf for the trade executions. So historically, we have worked with a number of managers across the board. We also have separate relationships with them directly, as well as a number of brokers within the industry where the managers are trading on your behalf. So historically, the managers were able to trade with any brokers of their choice. And we also worked with those various brokers, communicated with them, and we kept, in-house reporting and ledgers to kind of, calculate and keep track of everything and manage the overall program for our clients. But going forward, in order to participate in the commission recapture program, all of the trades that the managers are trading on your behalf have to go through Northern Trust Securities. So in order to receive the commission recapture benefit, where we are, looking at your commissions, providing the various reports and managing and, keeping a tally on what your cost is and what you're paying, and trying to keep those costs down for you or provide a rebate, all the trades.
Antoine, we're getting some feedback. Sorry. Antoine? Hey, Antoine, are you on? I think we've got a little feedback from you there. And can everyone else hear me okay?
Yeah, I can hear you.
Oh, okay. Okay, good. Antoine, did we lose you? While Antoine's coming back on, like I said, I did want to be more mindful of your time. So I'm going to let him get back on here. And I'm going to have a question for Antoine too when he gets back on. But real quickly, if you just want to go to slide 32. And Antoine, when you're back on, feel free to just cut me off. Slide 32 is a...
Can you guys hear me?
Oh, there we go. Okay, go ahead, Antoine. Sorry about that.
Yeah, sorry. It was telling me to press *6 for some reason. I don't know why.
Okay.
But, so yeah, I guess you guys heard all the beginning part of that, right?
Yeah.
Okay. Yeah. So going forward, all the trades have to go through Northern Trust Securities, and again, we are a full-fledged broker dealer. We work with pretty much every investment manager, every broker dealer out there. So the change doesn't affect Fresno directly in terms of, being able to participate in the program and receive the benefit. The impact really will be on the managers in terms of historically they would simply call whatever brokers they want. Now, and it only applies for the trades where you are looking to receive benefit or the trades where they want to direct towards the program. So it's not 100% of their trades. We're not looking to change how they manage their program or how they, manage the portfolio or anything like that. This only has to do with commissions and the cost. And in order to receive that benefit, then they have to trade with us. Just so a little bit about us in terms of how we trade. We are agency only. So every trade that we do is in the best interest of the client. We do not have an internal proprietary book that's positioned against our clients. So everything that we do, we're going out to our various brokers that we deal with and over 1,400 different clients to get best execution. So in many cases, some of the managers may actually see a benefit and an increase in the value in terms of having to trade through us, going forward for the commission recapture program. And as Jerry will kind of go through some of the slides, you'll see that only 3% of the historical trades have applied. So as more trades are being done, then the benefit increases and you're able to kind of, manage the expenses more and keep an eye on that. So I'll just stop there.
Any questions so far?
I guess maybe I have a quick question. It sounds like this change that I'm going to guess managers will be a little less likely to trade through Northern than under the previous arrangement, which would lower the volume. Is that a wrong assumption, or is it too early to say? What?
Yeah, I would say that is a wrong assumption because the managers, many of them we already have direct relationships with, and they were already using Northern Trust. So what you see in terms of what commissions are being directed were only for the trades where they flagged that would actually be included in the program. So now when they trade with us, all those trades that they're trading with us will be included in the program. Now for full disclosure, you will get some managers that simply, either have preferred brokers that they deal with, or they know somebody they're really close with and they want to deal with those people and no one else. So you do have some of that. But again, we're not asking for 100% of their trades to go through the program. Typically, what we see in the commission recapture program is about 20% of the trades are going and being flagged for commission recapture. And again, we deal with all the brokers that are in the street. So if a manager comes to us and say, hey, I know X broker has an ax on this, or, you know, we will likely weed that out anyway. But if they came to us and specifically said, we want you to work with this broker or go to that broker, then we have no problem doing that, again, because we're operating in best execution. But even in those situations, we found that when we've been asked to go to a certain broker, when we do our due diligence on behalf of the client, being yourself, we find that that particular broker isn't the best, you know, in terms of the execution quality and the price for that particular item at that point in time, because of how we pigeon all the brokers in competition, and we also utilize our client base to get best execution. So you will see some hesitation, but all in all, again, this is a benefit for Fresno. And I think you have to keep that in mind in terms of, you know, regardless of, you know, which way the managers are leaning, at the end of the day, this is more of a service and oversight and a cost management tool for Fresno.
And briefly, when did this change start? And when does it become official?
Yep, so it's already official. We actually delayed it for you guys, given today's board meeting. So as of August 1st of this year, all of our other clients have already migrated over to the new program.
Thank you.
Any other
Okay, is there
questions?
any other questions from the board, from either employees or fire police? Hearing none, go ahead, Jerry, and let's wrap it up so we can move down the
Absolutely.
agenda.
No, I want to be mindful of everyone's time. I'll be very judicious here. So just as Antoine mentioned on slide 32, 3.38% of your trades did go through the commission recapture program. So 96.72 did not go through the program, which makes sense because your investment manager, I mean, not all the trades would go through the commission recapture program. Your investment managers would always be looking for best execution, and then also for some of the other reasons Antoine mentioned. For your fiscal year, July 1st, 2019 through June 30th, 2020, there was a total of $4,056.36 in rebates. If I were to compare this to last year, you had 5.85% of the trades go through the program, and there was $13,773.43 rebated back to the plan. If we go to slide 33, it's just more granular detail on your specific investment managers. So when you're looking at the slide, you'll see that really Kennedy Capital Management is the one most utilizing the program. I mean, they're the ones doing most of the directed commissions that we're going through. You see it's more, it's less so on for the other managers. And then if you want, the very last part that we'll jump to is just slide 36. Now on slide 36, from 7/1/2019 through 6/30/2020, we've taken in a total of $176,261.87 in class action receipts. The largest class action receipt was $105,875.20 from Petroleo Realizario. Then we also received a second distribution from Petroleo in April of this year, which amounted to $20,425.08. That's common. So what happens with the class actions, they'll pay out an initial distribution, then they'll continue to pay out distributions until the fund runs out of funds. So they'll continue to pay those out year over year. If I was just comparing this to last year you received a total of $61,135.23 in class action receipts. So there was a sizable jump this year, again, mainly due to the Petroleo Realizario. But then I know last year when I also did a 5-year historical for the class action proceeds. Taking all of the past 7 years combined, it averages out to roughly around 100,000, or a little bit more than that, a year in class action receipts that we're bringing in and giving to the plan for filing on your behalf. taking in from the claims administrators, tracking those, and then depositing those to your account. Any questions about anything else that we've talked about so far? And I apologize again about going slightly over here, but thank you again for all your questions. They've been very good.
Thank you, Jerry, and thank you, Northern Trust, for your presentation.
Thank you, everyone. I hope everyone has a great day, and thank you again for having us.
Thank you all.
Does anyone need a break, or can we just keep moving down the agenda? Hearing none, we'll proceed down to A, the consent calendar on the fire and police side. Is there anything to be pulled for discussion? If not, can I entertain a motion?
Jensen will make a motion.
I have a first. Can I have a second?
Don Gross will second.
I have a first and a second. I'll call for a roll call vote with John.
Aye.
Lynn.
Aye.
Don.
Aye.
Brad, are you on? And with my vote, the consent calendar passes unanimously.
Rob, you may need to speak for Phil.
Okay. Phil had some technical difficulties when we heard the big
Yeah,
feedback.
can you hear me?
Oh, there you are.
Okay. All right. Yeah, phone dialing's complicated.
Okay.
All
Fire
right.
and police, Phil, fire and police just passed the consent calendar.
Yeah, I heard I was muted.
Okay.
And so I'll entertain that same motion for the employee side.
David Kane motions.
Thank you.
Miller,
And
second.
thank you, TJ. And so I'll take a roll call. Alma,
Aye.
David,
Aye.
Marvell. Marvell, are you there?
Marvell, you need to unmute.
All right. And TJ?
Aye.
Okay, and I'm affirmative, so it passes unanimously with Marvell absent.
Okay, moving down the agenda to staff-initiated items B1, discuss and consider termination of commission recapture program. Is that Rob, Chad, both of you?
Both of us. It's, as Northern Trust pointed out, this is on the agenda to discuss a very antiquated process. Commission recapture has become less and less effective as a revenue generation and is in fact starting to be viewed as more of a soft dollar arrangement, which is for the newer trustees, an antiquated means of hiding costs and making sure that things aren't properly vetted. What brokerage firms would do or pension shops would do in the past, I'm looking 20, 30 years in the past, would be make sure to direct trades and trading through certain brokerage houses who would share some of that revenue with them, which they would then use to cover specific costs, like the Bloomberg screens, the Telerate, which is really dating myself, I guess, but or research. So since we've got commission recapture falling off, then we've also got trade cost analysis provided by Zeno, and you've got a good eye on it. It really doesn't make sense in my mind, and not speaking for Chad, he'll be next and he can put his own foot in his own mouth, that it doesn't make sense to continue the commission recapture. It's not cost effective. It's a hurdle in front of our managers that's not paying off for the boards or the pension funds. Chad?
Thank you. The only thing I'd add is that as Northern confirmed, we only have one manager that is really utilizing the platform. And also, as the memo states, it's, as Rob said, it's a legacy process that through time has kind of become inefficient and irrelevant. So now with the new IPS, the investment policy statement that was approved in January this year, that is actually not part of the policy statement at all. So essentially, our managers, our public managers, have the ability to use any broker that they feel will provide best execution. And just saying exactly what Rob said, we have the TCA with Zeno. That captures that, along with many other metrics that we can see how and where the managers are getting or not getting best execution and impacting the market.
Okay, any other questions from either boards? With no questions or discussion, I'll entertain a motion on the fire and police side for the joint boards to terminate the commission recapture program via Northern Trust.
Jensen will make the motion.
Lynn will second.
So I have a first and a second. I'll take a roll call vote with John.
Aye.
Lynn.
Aye.
Don.
Aye.
And with myself, it passes unanimously.
Employees, I'll entertain the same motion.
Miller, I'll make the motion.
Thank you.
Kane, seconds.
Thank you, David. And so I'll call for a roll call. Alma?
Aye.
David?
Aye.
Marvell? Oh, and TJ?
Aye.
Okay, so, and I'm affirmative, so it passes unanimously with Marvell absent.
Okay. Now, moving down the agenda item.
So the real estate company is going to have.
Oops. Moving down the agenda to item B2 to discuss and consider adjustments to Acadian guidelines. Rob and Chad, you still have the floor.
Sure. It's very simple. The Acadian portfolio is a quantitative, process-driven portfolio that unfortunately is making, or sorry, fortunately or unfortunately, depending on your point of view, is now making, sorry, too many pieces of tech, making concentrated or a little more concentrated bets than they normally have in the past, and notified Chad that they'd like to adjust the guidelines. Typically, they had held between 300 and 450 total names in the portfolio. They are currently below that. And after discussion with, and again, not wanting to put words in Chad and Don's mouth, after discussion, we felt that it seemed reasonable to eliminate that lower threshold. Their model and their process tend to smaller positions spread very broadly. That's why they have such a high, or had such a high target range to start with. But allowing them the freedom to concentrate a little bit when they've got more conviction seems to make sense. Chad, Don, any comments, snide or otherwise?
I think that captures it quite nicely.
I would just agree. I mean, that is a lot of stocks. So cutting it to having it slightly below 300 is still an extremely diversified portfolio, as Rob was suggesting. So we're fine with it.
Especially when our other emerging market manager, Axiom, has around 100 positions. So Acadian has 3 to almost 4 times more names in the portfolio than Axiom.
Okay, any questions or comments from either board? Hearing none, I'll entertain a motion from Fire and Police that staff and EPC recommends the joint approve the new guidelines for Acadia.
Don Gross will make the motion. New guidelines.
Jensen will second the motion.
So first by Don, second by John. I'll take a roll call vote with John.
Aye.
Lynn.
Aye.
Don.
Aye.
And with myself, the motion passes unanimously.
Okay, and employees, I'll entertain the same motion.
David Kane motions.
Miller, second.
Thank you. And so I will take a roll call. Alma?
Aye.
David?
Aye.
Marvell? TJ?
Aye.
And I approve as well. So it passes unanimous with Marvell absent.
Okay, moving down to board initiated item C1 to review and accept annual travel report for fiscal year 2020 showing educational conference attendance by retirement boards and retirement office staff.
Annual report, Kathleen, Alberto, do you have anything to point out other than the fact that travel seemed to drop off rather precipitously a few months ago? Something happened. I can't really remember what it was, but Kathleen, Alberto, anything to add to that, or?
No, that's correct.
No.
There's hardly any travel on it. Thank you.
That's same here. It's pretty much not
Thank
much
you.
on there.
Okay.
Any questions or comments from staff or from the boards, either board? With that, I'll entertain a motion on the fire and police side to accept the annual travel report for fiscal year 2020.
This is Lynn, I'll motion.
Don Gross, second.
First by Lynn and second by Don. I'll roll call vote. John?
Aye.
Lynn?
Aye.
John?
Aye.
And with myself, the motion passes unanimously.
And so employees, I'll entertain the same motion.
Miller, I make a motion.
Thank you.
Kane, second.
Thank you, David. I will take a roll call. We'll start with Alma.
Aye.
David,
Aye.
Marvell, and TJ.
Aye.
And I'm affirmative as well, so it passes unanimously with Marvell absent.
Okay, and moving down to agenda item C2, consider NEPC's quarterly investment report, what we're all anxiously waiting to hear. Rob, Chad, and Don?
This one's all Don.
Thank you. I appreciate the enthusiasm, Mr. Chairman. That's wonderful news. If you could perhaps pull up the report and we'll start on page 2. Thank you, Patty. So on the next page here, we'll start as you recall, we'll review performance. I'll be a little bit brief, but the first page and here we go. So this is just a summary. You'll remember that the board asked a while ago for a 2-page summary, and we have compressed the performance report in general and made it more brief. So, as obviously people are implying, a lot happened in the second quarter, really amazing from a number of different perspectives, and I'll comment on a few of them. The first point, its headline is a shocking number. I will stress that that is an annualized rate. So it suggests if the economy dropped for 4 quarters in a row at the rate it dropped in the second quarter, that would be the overall effect. We've already seen that that's not happening. We've seen a nice recovery somewhat, certainly not a V-shape. So we're definitely not back to where we were at the start of this downturn. And our expectation fully is that additional economic or GDP recovery and unemployment recovery from here will be quite a lot slower than we've seen. But certainly a fascinating quarter from an economic, fascinating is a poor choice of words, a stunning quarter. Economically, we've seen interest rates, to Northern Trust comments, interest rates dropped to historical lows. We would be supportive of an argument that they're unlikely to go up anytime soon. 5 years is a little bit long for anyone to be making a forecast these days, but be that as it may, really incredible performance for U.S. stocks in this second quarter. The S&P was up over 20%. That's actually the 4th highest quarter in stock market performance in the last 45 years. So the 4th highest in 45 years. It trails the highest quarterly return by 1.5%. So the market was up something about 20.5% in the second quarter. The highest was up about 22%. So really a stunning recovery and some really significant divergence in performance, not only in US and non-US stocks, but in other areas. Most importantly, you can see net performance for the last 25 years, 7.5%, which is ahead of the assumed rate of 7.25. That is the current assumed rate. It was higher over the last 25 years, but still, that is supportive of a belief that we certainly have factually earned the current assumed rate over the last 25 years. And manager selection, and these last 2 points haven't really changed. Quarter to quarter manager selection has really been a positive contributor, more so for the city of Fresno than our average client. You could turn to the next page, a little more detail on the performance. Having talked about some of the good news, you can see the 1 year number, the total fund returned 1.3%. Why is that important? This is the end of the fiscal year as of June 30th. The assumed rate for that 1 year period, 7.25%. There's a lot of averaging that goes on in calculating the actuarial return. It's smoothed over a 5 year period. We'll be using returns from previous years, but clearly the last 12 months had a negative effect on the actuarial return, although you only, again, experience 1/5 of that in any given year. For that period, we did outperform the benchmark net of fees, and we basically ranked at the median of our peer groups. So when you look around at other public funds, they all earned in that kind of 1.3%, or at least that was a central tendency. Some more. CalPERS actually had a very good year this year, a little bit unusual for them to outperform significantly. But that was the median for a 1 year period. What that tells you is that there is going to be increasing pressure to some degree on public funds because as a universe, they underperform their assumed rate. And then I'll suggest we move to the next page. And here from an economic environment, we talked about the GDP growth. I think the way to summarize this page really is we're in a period of heightened uncertainty and really an elevation. So really the future path of the economy to some degree is going to be dependent on how the virus plays out. I could paint a very positive picture of the unfolding of the pandemic in the US and what that's going to mean for the US economy. I could paint a somewhat more negative picture. So there's certainly a fair amount of uncertainty. Unemployment, you can see, has spiked. It's come down nicely, but still it's at an elevated rate even after 2008. So even after the global financial crisis, the last major downturn we had in economic and stock market activity, unemployment's still higher than that. And then I think the final point is important. S&P valuations, and in fact, most asset classes are pretty high. And so when you think about the valuation of the stock market, we think about price to earnings ratio, that's elevated. When you think about the valuation of fixed income securities, that's driven by the yield, and yields are at almost an all-time low. We've seen high yield bonds, which spiked to have a more attractive spread or return over treasuries at the end of March. That's compressed, so the return is lower than it was just a couple of months ago. So we have a situation where you have an elevated degree of uncertainty and you have expensive assets. And if you think about it from an intellectual basis, when you have elevated uncertainty, when your path to the future is less clear, you would basically value those assets less, all things being equal. Another way to think about it is intellectually, if you have a very secure, known return stream, you'll pay more for that than you will for an unknown return stream. We find ourselves in a slightly different position. I just observed that the markets are expensive. We've said that in the past, but it's still true today. If I could direct your attention to the next page, and I'll get a little bit closer because these numbers are small. and I will increase it a little bit on my side. So we talked about the performance of the S&P 500. If you were to look at 1-year numbers, and I apologize because my face is getting very close to the screen. It's not for the benefit of the viewers. Obviously, it's to see the numbers. You can see if you start looking down that 1-year column, 7.5% for the S&P 500. Very significant difference between growth and value. The Russell 2000 small cap stocks dramatically below the performance of large cap stocks, significant negative. You can see non-US stocks, Bailey Gifford's purview that we just heard, negative, looks like about 4%. So then you look at Barclays aggregate positive. My point here would be simply, as you start to put together those pieces of a diversified portfolio, there really is no way you can get to that assumed return looking at the component pieces. You can look at some of the diversifying assets down at the bottom of the page. We have some exposure to commodities, and we'll be talking a little bit later today about our MLP exposure, but commodities in general, heavily driven by oil, negative for the 1-year period. You can see real estate flat, and you can see the Wilshire REIT index, which is the liquid real estate index, pretty negative for that period as well. So I think the points I would make for a 1-year period, hard to put together a diversified portfolio to earn the assumed rate, and significant divergence between asset classes, with the US stock market doing quite a bit better. And quite frankly, if you were to peel the onion behind, let's just say peel the onion, I guess, in the S&P 500, significantly driven by the top 6 stocks. So when you think about the extended FANG stocks of Amazon, Netflix, Google, those really drove the S&P 500. If you weren't in those, you didn't do nearly as well. I'll direct our attention to the next page, and I'll probably be skipping a few pages, but okay, this is an important page that we don't want to skip. This is the total fund performance. So importantly, for that 3-month period, very nice returns, 12.9% for the fund. That ranked in the 12th percentile. Again, the implication is that our 3-month return outperformed 88% of the public funds we're looking at. And again, our database is public defined benefit plans above $1 billion. We think it's a very representative sample. We were well ahead of the policy index. Again, the policy index takes our target asset allocation, multiplies it by the passive benchmark we use in each asset class. That's what we would have earned if we had index returns in every asset class, and we're exactly allocated according to our target. Nice outperformance. You can see the 1-year number, as I mentioned, just about median. And I think importantly, if you look at the 5, 7, 10, those longer term periods, the relative performance well above median. So again, a median performance would be 50th, which would be average. 5-year number 31st means you're outperforming roughly 70% of the funds. Again, our target really should begin and to some degree end with getting our assumed rate of return. But it's important to put in context how we've done, in context to what was available in the capital markets by looking at what indices did. And then it's interesting to know what other public funds did as well. We don't live in a vacuum. Clearly, your constituents will bring up what other public funds did. And over these longer time frames, we happen to do quite a bit better. I'll stop there quick. I'll ask if there's any questions. I would encourage questions at any time about anything I'm talking about. Hearing none, I'll continue, but again, do encourage it. This is an important page as well. Just a quick check-in on our asset allocation versus target. Sorry about that. I should have turned my phone off. Anyway, so here we're looking at our asset allocation versus our policy target. I'll note that we are working with staff, and in fact had a discussion today, and one of many, working towards delivering an asset liability study that would include recommending changes to the target mix, likely early next year, and any changes that we recommended that were adopted would be implemented at the start of the next fiscal year. So As an aside, you can see we're very close to policy across our current versus policy, with some exceptions. And let me highlight those exceptions. We are over in large cap equity at 22.7 versus the policy at 15.6. That is a little bit over target. The way I would view that is as a placeholder for other asset classes that we're looking to deploy capital into. It happened to be a very good place to have capital over allocated to over this time period. But in particular, if you look down the chart a little bit further, you'll see that in private equity, we are at 1% currently. We have a 4% policy target. So you can view that 3% underweight as being held in large cap, and to some degree also the real estate private, where we've gone through a process, you'll recall, and have hired a core plus private real estate manager that we haven't funded yet. That capital is also being held in large cap equity. Otherwise, you can see pretty close to target, a little bit below in private credit. As you'll recall, we did go through a lengthy process and identified Arcmont as a European direct lending manager. We're about fully wrapped up on the contracting, and they would start to call capital. Otherwise, we're very much on policy. I'll suggest we move on. Yes, sorry.
This is Lynn. Can we go back one slide? I did have a question.
Of course.
I get a little confused about these percentile rankings.
Yeah.
So just, can you clarify me? It says on that slide that our fund volatility is 9.94%. Is that bad?
Well, I wouldn't say bad or good, but factually our volatility is higher than 91% of other funds. So what drove that higher volatility is a strong commitment to equities, primarily US equities, but also non-US equities. So on average, we have more equities than our peers. Equities are more volatile. Now, the reason I was hesitant to say that's bad or good is equities have been very rewarded over this time frame. That's one of the dominant reasons that our performance relative to peers is so high. But that is also something that I've said in the past, and I think staff would agree with me, that we would like to lower over time. It's clearly a trailing indicator, right? I mean, we're looking at the last 5 and 7 years of volatility. So if we radically change direction today in terms of our asset allocation, it would take a while to fully play out in a 5-year number. But clearly the annualized standard deviation, which is a measure of risk, is higher than other plans.
And just to put my 2 cents in it, we have been working on a strategy to lower that volatility. And if you look at the next page, the policy has been changed to increase things on the lower end of that bar chart that are less, not quite as risky from a long-term standpoint.
I would echo those comments, but also provide a little color. So clearly adding private credit, which was a newer asset class, I'll say 4 years ago, something like that. That's lowered the volatility. Infrastructure has lowered the volatility. We will get into some more details about this during our lunch education session, but the energy infrastructure has not been a volatility dampener. Quite the opposite, that has enhanced it. But in general, Bill is correct that we've been lowering the volatility. Any other questions? I think I will stop there. We could, I'll leave it to the board's discretion. We could go through a review of the individual managers. There is nothing particularly to highlight. I'll suggest that you'll recall our outperformance versus the policy for the quarter was quite attractive. So we do have some individual managers who have done really quite well. And I'll certainly mention Bailey Gifford as one that we just heard from. They've done incredibly well, not only recently, but over an extended period of time. But in the interest of time, there's certainly no concerns from my, perhaps I'll alter that. Well, no, I won't. I was going to suggest we look at the energy infrastructure, but we do cover that in the educational presentation. So there's no need to look at it now.
Okay, are there any other comments or questions, concerns from either board? And hearing none, motion required to accept, or correct?
Jensen will make a motion.
So on fire police, I have a first. Do I have a second?
Russell, second.
I have a first and a second. I'll do a roll call vote with John.
Aye.
Lynn?
Aye.
Don?
Aye.
Congratulations, Don. Fire and police accept your report.
Yay.
And on the employee side, I'll entertain the same motion.
Motion to approve is Miller.
Thank you. Thank you, David. And so I will take a roll call. Alma?
Aye.
David?
Aye.
Marvell? And TJ?
Aye.
And I approve, so it passes unanimously with Marvell absent.
Okay, and we'll move down the agenda to board initiated item C3, educational asset class reviews, private equity and midstream energy. Rob and Chad, is that you?
That will be Don.
Don again.
We can only call it your lucky day. So we'll exactly perhaps jump into the presentation. And as a quick introduction on that, so you'll recall we've adopted an approach of providing an educational background and perspective to the boards prior to managers coming in. So next month we have our private equity manager coming in, which is Pantheon, and our 2 midstream energy managers coming in as well. So this is really an opportunity to sort of review the asset class, what our exposures are, give some background on the details of why we have it, and really give the board an opportunity to ask any questions. So I would encourage that throughout, as always. We're going to start, we'll handle each one separately. So we'll start with private equity, and they'll certainly have a very different look and feel. So if we could turn to the next page, and the next page after that. So from an asset class overview, our target allocation to private equity is 5%. I will get into some details about why we currently have 1% allocated, and this is money in the ground. So money that's been called is the technical phrase, and invested. Our exposure here is through what we call a fund of one. So we've hired a single firm, Pantheon, who is then deploying the capital to a number of different partnerships. They'll be talking about how they've deployed the capital and the exact, to some degree, partnerships they've selected in the meeting next month. So that's the position it has in the portfolio. On the next page, you can see, and then one more page, a little bit of an overview on what private equity is. I think the second point is important. It is viewed as a return enhancer. So the goal is to earn a premium with a partially, basically a premium over what you could get in US and non-US equity markets. The belief is that premium can come from partially being compensated for taking liquidity risk. This is money, we'll talk about it in a while, that's tied up for a multi-year period. Also creates an opportunity for real direct value add services to the corporations or the portfolio companies that Pantheon and the firms they're selecting are investing in, we think that additional opportunity to add value can be significant. It's a pretty large investable universe. You can see there's approximately $3 to $4 trillion in assets under management. We have a figure here, $400 billion is raised annually. That'll make a little bit more sense when I talk about how this process works in a few minutes. But it's a big universe, so that gives you a lot of opportunity to find attractive investment opportunities, gives you a lot of opportunity to diversify your exposure within private equity, and we'll talk about that as well. Two obvious sources of potential returns. The diversification, it's not fully correlated with public equities, but there is a lot of correlation with public equities. You think about it, and we'll describe this more in a minute, we're buying shares basically in companies that are private. So there's no other owners, or it's a very limited subset of owners. At some point, those private companies will go public. Maybe they used to be public, they've been taken private as part of this process, and they'll go public again. But clearly valuations in the public markets have a significant effect on valuations in the private markets. That is a very clear relationship. On the next page, here's some look at how that's different from public equity. We talked a little bit before in the performance report about the S&P 500. We didn't get into the individual managers, but some differences. Daily liquidity in public equity. The managers or we can make decisions and exit strategies, in most cases within a day or a couple days. Private equity, illiquid, these are 10+ year commitments. I kind of referred to this earlier. Public equities, we can make a decision and the capital is deployed pretty quickly. In private equity, it's invested over time. That has advantages and some disadvantages. One of the advantages is that your exposure is spread out. You have something called vintage year diversification. That's actually a positive. And we'll be seeing in a few minutes how some of the best investments made in private equity were made in 2009 and 2010 year vintage firms. And what that means, funds, vintage year funds. So these are funds that were created right after the stock market was down significantly. And as that capital was deployed, it was deployed at lower valuations and worked out quite well. I don't want to take too much time. There's differences in valuations. There's quarterly valuations similar to real estate. You don't get daily pricing. You don't get market pricing. The fees are a little bit different. I think that sort of captures the difference, perhaps. Turning to the next page. This is a look at the mechanics, and I'll spend a few minutes here. Probably would have made sense to put in the names. So I'll do this verbally. The fund general partner. So that would be Pantheon, or actually funds that Pantheon invests in. But let's just say Pantheon / funds that they invest in. The limited partners on the left would be in this case, there's only one in our fund of one, which is the city of Fresno. If you're thinking about one of the underlying funds that Pantheon has selected, it would be the City of Fresno Fund of One and some other funds. And on the right-hand side, those are the companies that the funds are investing in. So you can see how it works. There are capital calls, and that means that we would get notified by Pantheon that we need to send money to them because we have committed that 5% to Pantheon, but you'll note they've only called 1%. So from time to time, they'll notify us that they're calling more capital, that they have investment opportunities they want to make. So that would be money flowing from us to the fund, and then distributions would be coming back from the fund. Investments are made into the portfolio company, and once realizations occur, they come back to the fund. So the way you could think about it is we make contributions, companies are purchased. Let's say in a buyout situation, a large company wants to go private. They decide to go private. They hire a firm to provide, reach an agreement with a private equity fund to take them private. Private equity fund provides the capital, so they buy out all the public shareholders. That capital goes to the portfolio company. Theoretically, what happens is that portfolio company, the management is improved, the operations are made more efficient, then it is worth more money. The company then is resold to the public markets, and that is the realization, which has money coming back to the fund. That's a simplistic way to think about it, but that's how the mechanics work. Are there any questions on that page? I'll suggest that we go to the next page then. These are some points on the return drivers. How do you make money in a private equity? The first one, in my example, you're buying something for less than you perceive it's worth. You perceive that somehow you can add value to that public company, perhaps, using my example, increase the value and then resell it. One of the ways you can do that, obviously, is growing the earnings through revenue growth, cost cutting, and then leverage. There is leverage involved in private equity strategies. So by leveraging your investment, you can multiply or amplify the results. And of course, it's important, the last point, that amplification can be positive and it can be negative. And that's really it. I'll suggest we move to the next page. Here's the spectrum of different private equity strategies. I'll highlight them. I could get into more detail. I won't, but happy to. So when you think about private equity, some of the categories are venture capital. So the way to think about that is investing in a new venture, hence the source of the word. So the idea is buying Amazon when it had 3 employees, being the seed capital that helps get a venture, a new company started. Using the Amazon example, it can be tremendously successful. I don't have any hard and fast statistics, but the vast majority of venture capital investments fail. So this is a game where you're trying to have one really significant win, and you expect that 6 or 7 aren't going to work too well, and maybe 1 or 2 will be just average. But that's what venture capital means. Generally requires less money if you think about it, because when a company is first starting out, it doesn't require a lot of capital. Let's think about how much money Amazon needed when it started, I don't know what it was, 30 years ago, versus how much a giant utility in Texas needs to go from a public company to a private company. That utility in Texas, a lot less exciting, but that needs tens of billions of dollars to go private. Amazon probably needed $50 or $80 million. Growth equity is a term that's used to apply to companies that are farther in their life cycle than Amazon at the beginning was. So call it a company that's still private. Think about it as maybe Airbnb 3 years ago, as an example. So it's a company that's growing pretty rapidly. It's not what they call Series A or seed capital. So it's not a very early investment. The company has significant growth, but it's still private and it's still a little risky, but you've got a lot more visibility into what's likely to happen going there. Buyouts, something I described, buying out a public company. Again, that public utility in Texas, which was a good example of something that could be a buyout. For what it's worth, as an interesting aside, perhaps interesting only to me, but I'll mention it anyway. A lot of these buyouts has a private equity person buying that utility in Texas, and then that utility in Texas issuing high yield bonds that Loomis Sales might purchase, which is our high yield bond manager. Carrying on, special situations really are, as you can see, mature businesses that don't really fit neatly into another category. So there's something unusual about it and where it falls. Secondary transactions is a term that involves buying interests in funds that have already been created. So generally what happens is that we've hired Pantheon to manage a fund of 1. They go out and make numerous primary investments. So these are investment in specific funds that have expertise in Asian growth equity or US venture capital. At the time they make those commitments, other funds do, universities, high net worth people. 5 years from now, some of those investors might want to sell those interests in those funds that they made a commitment to this year. They can't get liquidity except in what's called a secondary market. So Pantheon for us and other investors will go into this market and buy it not from the fund company, but from an other institutional investor who holds that investment. So those are called secondaries. Generally, yeah. So we can talk about that more if you like. And then co-investments, from time to time, there's an opportunity to make an investment alongside Pantheon. This is something that we've historically chosen not to do, but are taking a fresh look at it going forward. What that means is that Pantheon might come out and say, look, in the underlying funds that we've invested in, they found this one great, I'll just stick with my example, this great utility investment in Texas. As they've put it across their funds, they've taken up 80% of the capital available to invest in. They're asking certain institutional investors like the city of Fresno, whether they want to make an additional investment alongside them in that. And it would be therefore a co-investment. Co-investments have the opportunity of being lower in fees. Many times there's no investment management fee at all. It's a more concentrated investment because you would have a limited amount of co-investment names. And we need to put some controls and risk parameters in place, but that's what co-investments are. Now I'll note that Pantheon, when they talk next week, will talk about their primary investment pools. They'll talk about their secondary investments, and they have a co-investment fund that we're also invested in as well. We could turn to the next page and another page. So this is the life cycle. I've referred to this from time to time, but just as a quick refresher, this is a typical closed-end fund life cycle. It applies not only to private equity funds that Pantheon is investing in for us. It also has a different years, but it applies also to private credit funds that we invest in and also real estate value-added funds. So has applicability across a number of different asset classes, and it's general for closed-end private market funds. There's a fundraising period when funds are open. They then have an investing period, which you can see we have a range, so it will vary. Credit funds will be shorter, more in the 1 to 2 year period, one to 5. Private equity a little bit on the longer side. After the investing period is done, individual funds will have a harvesting period. That's when they basically sell those companies that they invested in that I talked about. The value has been added, the money is being repatriated, and then finally the fund liquidates over years 7 to 12. So these are very broad ranges of years, and it's approximate, but it gives you an idea of the length of commitment that we make when we hire a private equity fund. And basically there are different things happening depending on where you are in the life cycle. And that has implications that we'll talk about in a few minutes, including on the next page. So here's something that's called the J-curve. This is a little repetitive for some of the people on the board, but as a quick reminder, and you can imagine the J, a little bit of a stretch, but on the upper right-hand chart where it kind of goes down for a while and then starts, you see it starting to recover on the right-hand side of that upper right-hand side. So the J-curve refers to your cumulative returns from private market funds. What this is talking about is how in years 1 to 3, a lot of times your results are negative. In some cases, you're paying fees on the total dollar amount that you've committed. Certainly capital is going out. You're making your commitments, you're investing in companies. Not a lot of capital is returning. At a minimum, you're probably not getting yield in a lot of different strategies, a little bit different in private credit strategies, but basically this is what the J-curve talks about. In the early years, you can have negative results, but then they start to really accelerate And you can see in years 5 to 10, returns can spike as assets are sold, and you realize a lot of these significant returns that you hoped for, and then you start to see a flattening out of the results. So when people talk about things like a J-curve mitigation strategy, what they're talking about is trying to mitigate those early couple years when your results are often negative and underwater. So to get a little positive return either from income generating strategy or by buying secondaries that have already been a little bit through their life cycle and will have less of a negative effect in the early years. I'll stop there. A lot of concepts. See if there are any questions before we carry on. I promise we're getting towards the end of the educational part, slash boring perhaps. Okay.
Hearing none.
Being incredibly clear, obviously. So turning to the next page. Portfolio implementation. I won't spend a tremendous amount of time of this. I believe Pantheon will talk about this in detail next month when they come in. But the point is there are a lot of decisions. We've retained Pantheon because basically when they complete their program, they'll have invested in 20 to 30 different private equity partnerships for us. That's a lot and would require a tremendous amount of oversight by the board. And it's probably not conducive to our decision-making process and pace. So a lot of this will come back, but they've certainly spoken to staff. They've spoken to NEPC and myself about how we believe this portfolio should be managed, the investment thesis. They'll be talking about this, very importantly, achieving what I talked about at the beginning, vintage year diversification, but taking advantage of market opportunities. And they'll be talking about that as well. I'll suggest we move to the next page. This is just the point that depending on your approach, that you can get a lot of dispersion in the results. You can see, and there are two takeaways from what is an illustrative chart, importantly. So this is not a guarantee. This is generally how things will work in private equity. One takeaway is if you look at that dotted line in the middle, you can view that's the average results. I'll note that the dispersion around the results in private equity can be really significant. So a really strong performing program that's in the top quartile or the second quartile can really add a lot of value to what you achieve, and vice versa. That's one of the reasons we went through so much effort in terms of identifying and selecting Pantheon to manage this program for us. The second takeaway is I would suggest where we find ourselves with our Pantheon fund of one is in that middle diversified funds group. So we have a diversified exposure. We haven't hired a bunch of really focused funds. We haven't hired a single venture capital fund and a single growth equity fund. We have a diversified exposure, and we're sort of in a midpoint in our risk return posture. Turning to the next page. Looking at the environment, I'll suggest we jump one more page now. There's a lot of pages and a lot of information here. I'm probably going to suggest that we go through this, but let me just talk about some general themes. So here, I talked about all the different strategies. Here we're looking at U.S. buyouts. We'll look at U.S. venture capital. I'm not going to go through every page, but this is available if you want to look at it and get some additional information. I think some of the takeaways, importantly, and they'll be consistent through the different strategies. One is we continue to be in a pretty strong fundraising environment. You can see that on the upper right-hand side of page, on the right-hand page. But secondly, on the lower part of the right-hand of the page, the illiquidity premiums, you'll notice in 2009 and 2010, this is what I was talking about. The higher that green line, which is the first quartile all buyout line, is above the PME. Well, I'm getting a little complicated here now, but PME stands for public market equivalent. Here we're looking at the Russell 3000. So this is your outperformance over what you could have earned if you just held a diversified pool of US stocks. So basically it's an argument that, all right, I'm more illiquid, I'm in private markets, I need to earn more than if I just bought, the Russell 3000. The farther that green line is above that's how much you're earning above and beyond that. And the point I'm making is that in that 2009, 2010 period, you can see that illiquidity premium was greater. And it was starting to shrink as we came into 15 and 16. The point being, again, what I made earlier, is that historically, periods after significant market declines are very good times to be deploying capital into private equity. That's not a guarantee, but that's an encouraging sign that the fact that we have only deployed 1% of our target 5% allocation means that we will likely be deploying a significant amount of our target at a very propitious, to choose a word, a propitious time in the cycle. With that, I'm going to skip the rest of these and suggest we move to the next section, but happy to address current details in any, but it seems like it's a bit much. I'll stop there. Then this leads us to the next segment, which is midstream energy, but any questions about private equity? Any thoughts?
Hearing none.
Excellent. So now I'll go to midstream energy, which, turning to the next page, these are the topics we're going to cover. A little bit different from private equity from a bunch of different perspectives. So here's what I'm going to talk about. This is a newer allocation for us. So I'll introduce you to the investment category. I'm going to talk a little bit about the situation in 2018 when we recommended an investment in this and the board approved it. We'll talk about that. We'll then talk about the current environment and developments, because clearly the results have been negative and disappointing. There's just no other way to talk about it. It's been, and you can see here, we'll talk about some of the issues that have occurred, and then moving forward, what's happening. And so obviously we have other clients that have exposure to midstream energy. So as a firm, we've been very focused on it. Staff and NEPC have already done 2 calls with our midstream energy analyst talking about the situation and our views. We will clearly be reviewing the role of midstream energy in the portfolio as part of our broader look at our asset liability study. We have recommended that we turn off rebalancing into this asset class until volatility subsides. So this is a situation where there's just so much going on into the space. We don't think it's prudent to continue to put capital into it. We don't think it's prudent to exit our current investments. But I'll stop there and see if there's any questions about any of that before I get into the details. But specifically the rebalancing thing, see if there's any questions or thoughts about that.
Don, what is the prediction? Well, in today's times, I don't know if you can predict anything, but from what I'm hearing a lot of is that more as people are working from home, it's going so well, there's not a plan for them to move back into office spaces. And so a lot less use of, oil and gas and all that. It sounds like long-term as opposed to just till the pandemic's over, but that's just what I'm thinking or hearing. So I don't know if you guys have any thoughts on that or where that's going to go.
Well, it clearly, and we talk a little bit about on this page, and we'll get into some more detail, there was both a supply and a demand shock that's occurred this year. The demand shock, of course, is the pandemic and the effects after that. You're starting to see demand move up, but long-term, I suspect it's going to take us a while to get back to where we were historically. So if you're asking me to predict what's going to happen. I would imagine, because a lot of our use of oil and gas is not in vehicles exclusively. There's a lot in industrial processes, a lot in, energy in general in the grid. I suspect we will get back to, let's say, peak oil demand. Let's keep it simple at that. But it's going to be much slower than we expected. So that would be my prediction. Happy. I don't know, Rob, if you have anything you wanted to add to that. Or...
Sure. To echo what Don was saying, the usage is not just limited to cars. I mean, think plastics, think of food storage, think all sorts of different things. And not that I ever read any economic forecast other than NEPC's, but most of what I'm seeing is showing guesses that the economy will recover fully out into 2022 now. So short term, yeah, it's up in the air. As NEPC has so eloquently put it, the thesis is under pressure and there's high volatility. It is something, though, that we've stressed in the past. We're looking at a long-term play. There don't appear to be replacements of sufficient value for the entire usage of petroleum, for the entire usage of what the midstream energy transportation grid is doing online. So I still agree with NEPC, much as it pains me not to be able to pick on Don, that this is worthwhile sticking in. It is so volatile, and as he pointed out, we've agreed that it's best to not rebalance or throw more money in until things settle down.
Yeah.
When they settle down.
Yeah. All right. Good points. Thank you.
All right, turning to the next page. Yeah, right here. So in terms of a little bit of a background on what midstream energy is, first I'll define upstream. So upstream is drilling for oil. So, finding, let's say, hydrocarbons, not just oil, gas, whatever. Midstream is the transportation of those hydrocarbons. Downstream, and a little simplistic, but you can think about it as gas stations, how it's distributed finally to an end user. So again, a little bit simplistic to call it gas stations, but if you think about that, upstream has a pretty high risk, right? I mean, this is a slight exaggeration, but you're drilling for oil. So it's, it's speculative. It can be less speculative if you're drilling right next to a property that's has oil, you've done your research, et cetera, but somewhat speculative. On the other hand, downstream, owning gas stations or distribution to the end consumer properties, that is generally obviously much less risky, but a much lower return stream as well. So the original thesis was, and remains somewhat true, it's a nice place to be in the value chain of energy. The general characteristics of these, typically long-term contracts. So oil producers sign long-term contracts with, say, pipelines, which is a major part of midstream energy, to distribute their oil from somewhere like the Permian Basin to where it gets either shipped or where it gets refined, et cetera. So generally a long-term contract. A lot of these contracts are what are called take or pay agreements, which means that you either ship your product through there or you have to pay for it anyway. So you take that capacity or you pay for it. A lot of times there's some general inflation adjustments, which can be helpful in terms of a general contract. I will immediately note that one characteristic that has become increasingly clear is that a long-term contract has value without question, but some of that value is driven by the credit worthiness of the person you sign the long-term contract with. So to the degree that you have a long-term contract with an oil explorer and prices have dropped precipitously and they go bankrupt, that long-term contract to ship oil is less valuable than it was, obviously, if they didn't go bankrupt. some of the other background information. So this is supporting the U.S. shale production boom. Clearly, this was a tremendous mega trend that was occurring in the U.S. and is still to some degree, where the U.S. oil production has dramatically increased. So again, kind of a midpoint and a risk return way to play that huge multi-year trend. And of course, the corporate structure has been evolving. Historically, we would call this area MLPs, which stands for Master Limited Partnerships. They had very specific tax treatment. There were some complications about that, including the fact they had to pay out all of their earnings on an annual basis. They've increasingly, the business, the ownership is moving to a corporate structure, which you could argue is more sustainable and more positive. But that's a little bit of the background. Turning to the next page. Importantly, this is a chart that the board looked at in 2008 when we were talking about making this decision. And let me, as I was looking at this morning, I noted that that first sentence on the left might be a little bit confusing. The point we made in 2018 was that relative to other asset classes, which were trading at or near their historical highs. So the point was midstream energy was trading basically at their long-term average. Every other asset class was trading near all-time highs in 2018. So that made this relatively attractive. And you can see that information in this EV, which is enterprise value to earnings multiple. So the entire value, both the stock and the bond ownership of the company times the earnings, it was trading sort of around average. You can see the price to the earnings trading a little bit below average. So in an environment in 2018 where the stock market was trading near all-time highs, and this was at an average price, made this relatively attractive. Now, of course, the stock market has continued to go up. This has gone down. So this argument, I could take two sides, is even more powerful today. But now in hindsight, this argument was clearly not accurate in 2018. Turning to the next page, this was another page shown directly to the board in 2018. So why did we think it was an attractive opportunity? High dividend yield. So again, our return is from capital appreciation and yield, but under a belief that high dividend yields relative to other options will drive valuations and have a what's called a multiple expansion, or people will pay more for that entity because the yield is higher, would move the price up. We certainly saw U.S. production growth trending higher in 2018. The potential inflation hedge in these vehicles we thought was attractive, and a more attractive corporate backdrop. So balance sheets were improving. You had overall demand increasing, supply was constrained. These were some of the arguments that were in place at the time we made this recommendation. Turning to the next page. So now what happened? Turning to one more page. So how did we get here? And I'm sorry, I'm not quite sure why this chart came out this way. It's undoubtedly our fault. You can see here, this, importantly to the question from Trustee Bennick earlier, this is showing the consumption versus production on a global basis. So very important in this relationship. You can see they're very closely matched, as you'd expect. People are producing basically what the market is demanding. I'll also note the figure is an important one: 100 million barrels a day. That has been the demand and the supply. To put things in perspective, when you hear about OPEC is deciding to cut a certain amount of production, that's with a backdrop of global demand at 100 million barrels. What happened, and I'm highlighting it with my cursor, but you can't see it. You can see in the right-hand side, you can see that dark green line dropping precipitously. That's the demand. So what happened was demand fell off a cliff, basically. You saw production drop, but not anywhere near the amount that demand dropped. I mean, huge cut in activity. When you have a lockdown globally, as we said, a lot of activity stops. Factories are closed. People are not driving around. Airplanes are not flying. Plastic is not being produced, et cetera, et cetera. So it created this huge change in the supply-demand balance. So what you had was a huge demand drop. That's the demand shock. There was a bit of a supply shock as well, which we'll talk about some more details, created this huge imbalance, which dramatically affected oil prices. So you can see some of the details ahead. Oil markets were expected to be oversupplied by about 2 million barrels a day. So expectation, a bit of an oversupply, something that can be dealt with based on the storage capabilities, et cetera. You can see what happened. You had that supply shock. Russia would not agree in early March, before the demand shock really occurred, to OPEC's terms to cut production. So they decided to increase production. Saudi Arabia decided to increase production as well. So you can see the amounts here. The Trump administration intervened in the OPEC meeting. OPEC alone agreed to finalize cuts of 9.7 million barrels. So that's an important number. And look at global demand down by 20 million barrels a day. So those are important numbers to put in that context of 100 million barrels of total global demand and total global supply. 20%. So a huge supply shock and a huge demand shock. So that's kind of how we got here. Turning to the next page. So here's the official recommendation for NEPC, which is we're recommending. It sounds terrible, but it's not terrible, but in keeping with our earlier comment that in this heightened uncertainty, it's not clear that any action makes sense. It's certainly not clear that selling a discounted asset makes a tremendous amount of sense. So we're recommending no action. We're saying while challenged, and that was Rob's comment, there's no question that midstream energy and the thesis that we talked about, and we talked about in 2018, is under significant challenge. We don't think the energy sector will disappear, but we think there's going to be significant challenges, not only from that demand supply shock, but that, there's going to be a repricing. There's going to be a lot of focus, as we've already seen, rig count, which is a figure of how many rigs are operating to drill new oil, has dropped. So production is likely to be challenged. What we've seen is an expectation that larger companies, not a shock, you would expect larger companies, more diversified companies with better balance sheets are going to do better. More marginal companies with a higher, more levered capital structure are going to be under more pressure. And you can see here's a list of some notable midstream energy companies. I don't know, I will suggest we have seen the investable universe has gotten a little compressed, which is something we're also monitoring. So there are less midstream energy companies today than there were in 2018 due to acquisition. So again, part of our ongoing monitoring is looking at that. I'll suggest we move to the next page. I don't know how much people want to get into this. There was a brief period when oil prices went negative. This is a lengthy discussion, which basically I can highlight in a couple of sentences. It's really driven by futures pricing of oil contracts. So there was never a period when oil had a negative value. There's still a value. People are still driving. Oil still costs something at the pump. But when you have to take delivery of an oil contract, which at the end of the day, if you can't sell that contract, means you have to take physical delivery of an oil shipment, and there's a tremendous demand shock. And so supply is really high. Storage capacity is at over 100%. You don't want to take that oil delivery because you have nowhere to put it. And so it really, at its simplistic way to think about it, there were technical pressures that caused oil price contracts to go negative. I'll stop there, see if there are any questions about that. Happy to get into some more details, but hearing none, I might move on. Yeah, exactly. Turning to the next page then. So here, I mean, this should be pretty evident, but clearly what we've seen, energy security is underperforming. So keeping the example simple, you know, huge, very specific energy shock to energy securities different from the economy. So you had not only what happened in the economy with the shutdown, which had an effect on energy, but it was even magnified more by the oversupply. So energy securities have done worse in the downturn and haven't recovered quite as much in the upturn. We expect this to get better, but again, it's been a difficult run. Turning to the next page. We've also seen an uptick in volatility. So clearly, again, and I'll hearken to one of the comments I had in response to a specific question about the overall volatility of the fund. This has been additive to the total pension plan's volatility. We never expected it to be hugely diversifying as much as credit, but the goal was not to add something that would be even more volatile than our equity holdings. So as we look at this in a broader context, in light of its role in the portfolio, clearly this volatility has been a huge negative. I mentioned rig counts. Rig counts are down dramatically. That means there are less physical rigs drilling for oil currently in the US and globally than there were historically. That's a clear indication that production is likely to decline in the medium term, therefore less oil being transported. I'll direct this to the next page. So looking at our portfolio, one more page, please. We're almost done. So the role in the portfolio, you can see the policy target is 5% to midstream. These are publicly traded securities. We have a 5% target. Today we're at about 4.2%. So we are below policy. We talked about not rebalancing back to policy because of what's been happening here. So we have two active strategies, and they'll both be presenting next month, and we'll hear from them directly. But turning to the next page, here's the results from our performance page. So as you can see, the midstream energy for the fiscal year to date. So this is, well, maybe I'll start on the far right-hand side. Since July 19th, since the money was deployed, almost exactly the full fiscal year. See, it's down 34.3%. So clearly under any scenario, really negative returns. The energy index down a little bit less. We can talk about when the managers are in. So we trail the benchmark over a very short period of time. But you know, this is an allocation that has done very poorly for us. Turning to the 3-month period, I'm not seeing 3-month returns here for some reason. I don't know why that would be. But the point I would make, if there were, I think these are, it's coming up for some reason for the printing. This 24.6 is the 3-month number. The fiscal year to date is 31.2. So the point is, nice rebound in this quarter, up 28.6%. That doesn't bring us back anywhere near to where we started from. And again, as we've talked in the past, mathematically, if you lose 50% of your money in an investment, you've got to be up 100% to recover all of that money. So that's a look at midstream energy. Happy to answer any questions if there are.
I have a question. Hello?
Yeah, of course.
And the question might actually be for Robert. So what is the purpose of all of this information? Is this for future decision making?
It's more of a review
Okay.
and making sure that you guys are aware of the past decisions to invest in these have resulted in this. So we want to make sure that you as the board members have significant amounts of information, a clear picture of the risk that's been taken and the rewards that have been generated from it for the fund. So the point of all this is to go through it, not ad nauseum, but in explicit detail so that you get a clear picture. It helps make sure that the past decision was well executed, and it does help with the future decisions as well. So the shorter version of that would have been column A, column B. Does that help?
Yes, it does. Thank you.
Okay.
And perhaps I'll just add very briefly. So to a comment earlier, these managers are coming in to review their portfolios next month, both on midstream and on private equity. So partially aimed at providing a lot of background on the asset class, why we have that exposure, and to give the board opportunities to ask questions that they might not feel comfortable asking with the manager there. So that's part of it. And the role in the portfolio, I think, is an important part. Here in Midstream Energy, a little bit more of a look at the thought process, partially because it worked out poorly. There's no other way to put it. I mean, this is an investment that has not done what we wanted it to since we made it. So, and then it raises the obvious question, looking forward, what we should do, which would come up with some recommendations. Rob?
I apologize, but yes, the performance has gone poorly, but the investment was made with a long-term thesis. The investment was made looking many, many years in the future, not just this year. So to nitpick, I disagree on that point, Don.
And this is Phil Hardcastle. I agree with Rob completely. We made this decision for the long haul. Yeah, we may be having a little misfortune at this point in time, but in the long run, Midstream Energy seems to have done well and stabilized things. And so I agree with Rob on this point.
And on an aside, I'd like to point out that I'm now batting 1,000% on two specific firms' recommendations to go into MLPs. Both of them have gone off the cliff right after I recommended it. So. But then,
I agree with Rob as well, and I didn't mean, and I apologize if I sounded defensive. It's just
it didn't take
we want everything to go up consistently.
Well, I'll add one comment, probably much to Rob and Don's chagrin. As someone who did not participate in the last asset allocation process when this asset class was approved, essentially. I have a different perspective, and to Trustee Bennick's comments, long term, do these have a place in the portfolio? We don't know. That's something we're discussing. There's been a lot of enthusiastic and philosophical discussions between Rob and Don and myself, as well as the head of real assets at NAPC in Boston, trying to figure out, does this make sense? Obviously the volatility is one thing, and as Don mentioned previously, and you picked up as well, our equity volatility over the last X amount of years is significantly elevated, primarily to equities, public equities, but also in the last year, the midstream has significantly increased that or enhanced it, as Don mentioned. But does this have a place in the portfolio? We don't know long term. Are the fundamentals there? I think we all agree that they are. How long it takes to play out, none of us know, obviously. And that's, I think, the big question mark hanging over this entire allocation, and that we're going to spend the next several months trying to figure out how to redefine it and how to move forward. So are there other alternatives out there? Possibly. We haven't seen them yet. And if we have, we haven't explored them or vetted them fully. But we're definitely looking and seeing if there is a potential complement to the equity component, a more neutralizing energy component out there, that maybe we could have a more blended and more diversified energy sleeve to the total fund itself.
With all normal Rob facetiousness aside, Chad's exactly correct. As Don stressed earlier, This has been incredibly volatile. It's been incredibly confused. And, to Lynn's question, the market has changed. The market has changed drastically. So we don't know exactly where it's going to wind up. But to stress again, I still haven't seen, and not putting words in Chad or Don's mouth, enough to change my mind over the long-term performance of the long-term thesis. Will it change on the anticipated expected returns? Absolutely. This has been a whale of an impact. So all joking aside, this is under review. As Chad said, it's something that we're concerned about. It's something that we're watching with exquisite detail. So no joking, it is up in the air, but I still have yet to be convinced that it's changed.
Well, in painful detail, I think I'm done with the midstream discussion.
It was a good presentation, Don. I really learned a lot from it, so I appreciate it.
So if there's any more comments or questions, or if there is no more, then we will move down to the next item on the agenda, which is general discussion. There are none. Information only items. Oh, I guess I was muted during all of that.
No, you were fine.
Okay. So we're on any proposed agenda items for the next board meeting.
We will have item B3 moved to the next board meeting, assuming, of course, that we do get the late legal paperwork in time to you for proper review.
Okay. I'd like to propose that Alma give us a J-curve mitigation strategy presentation as well. No, I'd strike that. Meeting after next. Congratulations on your appointment, Alma. Welcome to the boards.
Thank you.
And anybody else with an unscheduled oral communication? Are there any public comments? Hearing none, there are no employee personnel issues, and with that, we're adjourned. Stay safe, everyone. And
thanks very much, everyone.
Thank you. Bye-bye.
Thank you.
Bye.